With partnerships, allocated shares of income from their business are taxed as personal income for each of the partners. With a corporation, as a separate legal entity, it reports its income and pays any taxes related to these profits. The following two slides provide examples of how a sole proprietorship is taxed versus a corporation. In the first example, the sole proprietor is a married couple with an income of $150,000 versus a corporation that is taxed on $150,000 in profit. In these lectures, ordinary income refers to income earned in the ordinary course of business, including any salary. Capital gains and losses refer to the gains and losses from sale of property that are not part of the firm's regular business. Section 1244 stock is a special class of stock that allows the owner to claim an ordinary income tax deductible loss should the stock become worthless. Now let's look at specialized forms of organization and limited partnership structure. A general partner is active in the business and personally liable for the debts of the business. Sometimes partnerships are set up and operated without a partnership agreement. As you could imagine, problems can easily arise from this. If articles of partnership are not put in writing, disagreements and misunderstandings may arise about the respective responsibilities of the partners, the way in which profits are to be distributed, and many other matters. This can seriously interfere with the normal profitable operation of the business. By reducing understandings into written form, partners can minimize misunderstandings, differences in viewpoints, and overlooked issues. It also makes sense for some businesses to have limited partners. For the partners not active in the business, their liability is limited to the capital they invested in the business and nothing more. In this arrangement, taxable income and losses are still apportioned to each partner. The S corporation is taxed as a partnership and thus avoids the corporate income tax. Depending on the circumstances of the corporation and the owners, this can create significant tax savings. Its use is limited to small firms. To qualify for S corporation status, the business must have no more than 100 stockholders. All the stockholders must be individuals or trusts. Only one class of stock can be outstanding. They must be a domestic corporation. They must operate on a fiscal calendar year basis, and no non-resident alien stockholders can be on the board. The benefits of this is not only do you avoid double taxation, but the liability is limited to the investment in the corporation. There is no personal liability. With a limited liability company, stockholders have limited liability but pay personal income taxes on the business profits. Limited liability companies are easier to set up, they're more flexible, and they do have tax advantages. A professional corporation is also another good option. An LLC protects licensed professionals from the liability of their partners, but not their personal liability. A nonprofit corporation serves civic, educational, charitable, or religious purposes. It is not created for the generation of profits. Now let's move on to strategic alliances. A strategic alliance is an organizational relationship that links two or more independent business entities in a common endeavor. According to strategic alliance experts, strategic alliances are becoming crucial in building businesses of all kinds and at an earlier stage than ever before. Strategic alliances can decrease cycle time by allowing startups to access another firm's resources. Since an opportunity will often go to the entrepreneur who is fast enough to exploit it, many now see strategic alliances as an essential part of their plan for growth. Such partnerships represent one way to cope with the rapid change of today's business environment. It's worth noting, however, that 2/3 of alliances run into serious problems within 2 years of their creation, and 70% of them don't survive, which shows that alliances are hard to manage. Taking some basic steps can help entrepreneurs establish healthy alliances and reduce the risk of failure. First of all, you want to establish a healthy network of contacts. Then, identify and contact individuals within the firm who are likely to return your call. Then, outline the partner's continuing financial benefits from the alliance. Then, show the partner that your firm can deliver value to the alliance across several fronts. Finally, learn to speak and understand the language of your partner. Despite sound planning and execution, many strategic alliances fail, but some upfront planning can head off unnecessary failures if good communication is established in the beginning. This chart shows you the most popular small business alliances by type. You've reached the end of Part 4 for Chapter 8. Please proceed to Part 5.